All right. Hello, everyone, and welcome to the Invest in Denver podcast. My name is Sterling Coldani, and I'm a loan officer for Bank of England Mortgage Department here in Denver. I know what you're thinking. No, it's not across the pond, England. It's actually England, Arkansas. And we've been around since 1898 helping clients. If you're new to Denver or planning a trip to visit, make sure you check out Rhino and check out all the art that they have and while sipping a delicious adult beverage.
Nice. I will say that there's a couple of breweries over there, like Odell's, Ratio, and even like those bigger food halls that are like pretty dank, like what Number 38's, Zeppelin Station. All that stuff is like super nice and maybe on the outskirts of Rhino, but nonetheless, all of that is great for those adult beverages. So, what is your beverage, or not even beverage, but like your brewery of choice, Sterling, if you were to go to the Rhino area?
Yeah, so that's a great question. One of my favorites, just because they have multiple food trucks, is Improper City, and they also have lots on tap and a full bar. So if you're not into beer, they do have a full bar where you can get a mixed drink.
Nice. Dan, what about you? What are you into over in Rhino?
I don't spend a whole lot of time down there in the bar scene. Obviously, I'm coming from Longmont, but Blake Street Tavern, that area, spend a lot of time in there. I mean, it's stout
Nice.
season. I'll go with that. It's stout
Stout
season.
season.
Yeah.
It's the pumpkin beer season, man. I feel like
No, we're
I
past
will
that.
say that like no, well, dude, we're in fall. I feel like it's still like that holiday tradition, but like I will say that like those pumpkins, like the spicier pumpkin beers are more of my taste than let's say those sweeter pumpkin like pumpkin spice latte situation. But nonetheless, the like those pumpkin beers are hit or miss. You got to choose and find the right ones, yeah?
For
If you guys
sure.
are into it.
Well, as you know, I mean, I've spent some time brewing beer, and I think Sterling, haven't you as well?
I've done a brew before. Yes, I have.
Yeah. So I
Hmm.
mean,
Just
it
one?
changes every time.
Yeah,
Just one.
I
Yeah, I
dig.
got invited to, we hosted an event and we brewed our own beer for the event. And the head master, he invited the attendants to come. And I was the only one that showed up. So I got a one on one lesson on how to brew some beer. And it was really cool.
I mean, that's awesome.
Nice. Yeah, that's sick. And for those of you who don't know, Dan actually works behind the scenes, behind like a beer maker company thing.
That's
Yeah.
literally the name was Beer Maker. Yeah. We made home brewing machines. So I got to learn the whole process of brewing beer from start to finish, which is pretty awesome. And now I'm a full-time agent,
Hey.
so it's just enjoying the beers at this point. Let's go.
I dig it. Nice. Well, welcome to the podcast, Sterling. And Dan, always a pleasure to have you back, co hosting and writing co pilot. So stoked to get into this market trends report. And for those of you who don't know, we've mentioned this a couple times already for the past 2, 3 months already. Man, has it really been that long? Holy crap. So we have a market overview thanks to the Ruth team. Many blessings to you, team, for even coming up with this stuff. So major kudos. But October 2022, the stats are in with what things are going on, how they've been progressing all the way through October and getting into the November scene. So, with that being said, Dan, I know you were super stoked with this report coming out, especially in the nick of time. It literally came out this morning.
Yeah.
So, how do you want to start off with this? What are you seeing that might relate to you the most or might be most important?
So yeah, I guess following up from last month's report, we're seeing a lot of things happening. The market is continuing to slow, especially as we're hitting winter. I think the combination of interest rates, which we're obviously going to get into today, but combination of that and just the seasons changing, the markets continue to slow. So we could start with just some quick stats, or what are you thinking?
Yeah, let's do some.
Yeah. So yeah, this month we had active inventory is it's actually down 5.12%. Currently we're sitting at about 7,000 active listings on the market. We had closed homes down 24.5%, which is pretty significant compared to last month.
Mhm.
Average close price down 1.36%. We're coming in at 661,000 around that point for average close price. Keep in mind, remember we talked about this I think last month where the average close price is obviously different from the median because we're considering all homes up to, the millions of dollar range down to, 100,000 range. So the median close price is something that we're actually looking at pretty closely right now, and we're sitting at about 566,000, which is down again 2.4%. Um,
Yeah.
on top of that, yeah, I think the biggest factor is days on MLS. We're sitting at 28 days, which is we're getting more normal. I think what was it last month, like 20 24 something like that?
Yeah, I believe it was 24 days on the MLS. And what's interesting about that too is like over year, that's 100% increase. I think this time last year, there was only 14 days on the market. I think that was during the time where like coming soon from Tuesday to Thursday, showings Friday and Saturday, and then get a contract by Sunday. I feel
Boom.
like it's almost BYU with the wedding rings. You know what I mean? So
Yeah.
like things just happen super quick, you know? And going into the days on the MLS and even looking back on the like active listings at month's end, 7,290, which is down 5% from the prior month. So if anything, I see this more like, of course, there's that sort of variable of like, yeah, we're going into the winter months, but I'm also seeing like sellers seeing that trend ever since August of they're not getting top dollar for their listings. And maybe they're just
Yeah.
waiting it out until, maybe next year or things when are a little bit more demanding, where like buyers are like, yeah, I want in like as soon as possible. But sellers just don't want to get screwed over with like not getting top dollar on these homes. So I think that might be a reason why, especially going into the winter months, it's just a double-headed dragon going into it. Yeah.
I will add in on that as well. Just the demand has still been there. It's high. Like last weekend, I actually got outbid on a couple offers. If
Mm.
the house is priced right and it's in a good location, there's still people out there looking to buy and that can buy. Obviously, we have a lot of factors in play, but especially with our investor clients, like now's the time. Things are slowing
Yeah.
down and we can still make it work.
Yeah. What about you, Sterling? Are you seeing things on your end as far as like on a lender's perspective? I mean, with 2-1 buy downs or 3-2-1 buy downs. I mean, I'm still pretty new to this, especially with like, being a realtor starting with a really hot seller's market. And now we can actually get the time of day from the seller agent and then some, like with extra benefits, discounts on rates and all that good stuff. So what are you seeing on your end?
Yeah, excuse me. I would say that things have definitely slowed down. Higher interest rates have pushed some people out of the market because affordability has gone down. However, to Dan's point, it's still a great time to buy, especially investors. If you're on the investor side of things, still a great time to buy. Like Dan said, you're not maybe a few offers you'll get outbid, but for the most of the homes, you're going in at that purchase price, that list price, which is nice.
Yeah, I agree. And Dan, you were saying that you were getting outbid, so you ended up not getting that specific property that you were talking about, right?
Correct. But we did get the next one. So, it's just a matter
Hey.
of, continuing to look in the same area. This property was perfect. So I understood why,
Mm.
I went in and there was four agents coming in and out. So I had an idea that it was pretty hot. Um, but yeah, the next one went through good.
Sweet. Excellent. I know I'm going to jump you around, Dan, but if you go down to page 23, the one other metric that I wanted to bring up also is the close price over the list price. I feel like that's always a huge indicator of where offers are coming in versus what the list price started at. So the close price over the list price, we're seeing that at 98.83%. So we are still seeing a lot of these homes coming in under asking price. And to Dan's point, not every one of these houses are getting that under asking price, like going under contract. But those that are maybe not priced appropriately or are not in the most desirable area, you're getting, almost, just over 1% under the list price for that property. So I myself am still seeing that and I can attest to that. So maybe like going from the prior month, which was 99.12 into October, which is 98.83, we're seeing that decline in actual close price versus that list price. So is that something you guys can attest to as well?
Definitely. Yeah. I think most of the offers I'm hearing, especially on our team, is we've been under asking. And then we also have the closing costs and concessions. It's pretty typical right now. We're seeing at least five to $10,000 worth of seller concessions on top, just so that buyers can
Yeah.
continue to get in. Um, I think I'd agree with
Yeah.
that. I think we're going to
Nice.
continue to see that as well.
I agree. And it's something that is continually, especially going into the winter months. And like, that is something that I never thought that I'd be taking into heavy consideration, especially me coming from San Diego, where like, it's just spring and or summer, where it's not that much of a determinant, like having seasons being a huge factor in whether people want to move or buy or sell. So I don't know about your side on the lending side, Sterling. Like, does this even matter to you? Like what the close price is? Maybe like with appraisals, right? Maybe that part might affect you, but is there anything that's significant on your side as a lender?
So, not really. Yes, the appraisal is going to play a big part in that because lenders can only lend on the appraised or the purchase price or the appraised value, whichever is less. So, if you go in at 450, but it appraises at 430, and so you could still run into some issues. But yeah, these are the slow months. No one wants to move in the snow unless you're crazy like myself and move twice in the snow. So
Yeah. Nice. Did you move recently, Sterling?
I did not. I moved in 2020, and then actually both times in 2020. So moved out here in the winter and then moved again in the winter of 2020 or 20. Yeah.
Just
Yeah,
sounds like, but different seasons, right? Well, like early 2020, then late 2020, I assume.
exactly. Yep.
Okay.
So right at
Yeah.
the end of 2019 and then purchased in December of 2020 and moved again in the snow. So it's great.
I was like, dude, Sterling, how'd you get foreclosed on within like 3 weeks? That's crazy.
Imagine that. The loan officer did
Yeah.
not make his payments.
No, my landlord was selling their house, so he called my bluff, and we had to go and find a home to live in.
Oh, for real? Oh, damn, I
Yep.
didn't know that. Nice. Well, I know there's a couple of, I guess, talks, like there's that looming conversation that's happening within the Denver area of like, can I get pre-approved for this, especially when my monthly payment is going to be so high with the interest rates as they are, with the purchase or the actual list prices as they are, and things like that. So with people trying to get pre-approved and getting into it, they often have so many questions that I can't answer as a lender, but often they come to you, Sterling. So, what are some? I know you're bringing in some more resources for like slides and a lot of good stuff where we can pin down which variable determines the most or has the most leverage getting into getting pre-approved, having the highest budget, and all that good stuff. So yeah, Sterling, maybe you can just go right into it. And is there anything that you wanted to say prior to getting into your slides and your resources?
I would just say, if you are planning to house hack or you are investing in this market, as long as the numbers still work, I would say go for it. Numbers are pretty black and white, so that's a nice part. You're doing your math correctly, and you know that hey, someone's paying my mortgage, or at least my mortgage is decreased. It's still a good time to get in and leverage that to your favor. So when rates come back down, hey, now you're cash flowing even more.
And
Nice.
there's more than one way to make money in real estate, right? I think there's four ways that we look for. It's not just the cash flow. So
Yeah. So with that being said, Sterling, you can take the wheel and go from there.
So today we're going to be talking about buying power and how you can leverage your buying power in today's market. So let's go ahead and get started. Our objectives for today. 1, what are some key factors in a loan? Number 2, let's compare 2021 to present day. Let's look at your FICO variable and see how increasing your FICO can help you. Let's time in and not timing and why that's important, why you want to time in the market and not try to time the market. All right, so there's 3 key factors to a loan. Income. What do investors and banks look for in a loan? One of those being income. So with income, do you have stable income? Will this income continue for 3 years? Do you demonstrate the capacity to repay the mortgage and other monthly obligations, such as your bills, anything that is revolving? The next being assets. Do you have enough funds to cover the costs associated with the loan? Your down payment, your fees, everything like that. And do you have reserves? The next being your FICO. So FICO, do you have a credit score? Is your ability to repay the loan reflected in that score? So lenders and banks are going to be looking at these three main factors as they start building your profile. All right. So let's look at,
I guess
yeah.
real quick though, Sterling. I mean, with assets, right? I mean, there's so many things that people can consider an asset. I mean, some people might even consider a boat as an asset, right? Maybe like a social asset, but not like a legit. I'm making money off of this boat asset, right? I mean, maybe
Right.
they have like a Turo for boats. I don't know, but nonetheless, like a lot of people have crypto these days, or a lot of people have NFTs or something like that. I mean, are those applicable for assets, or what other common things that people might have questions about that you might not determine as legit assets? Or even if you do, is there a penalty for having these assets?
Yeah, so your common assets are going to be what you have in your checking and savings account, 401ks, stocks, bonds, things of the likes like that. Anything that you could liquidate quickly and turn into cash would be considered an asset. As we get into the crypto world, that's where things kind of get a little gray, right? Because the crypto market is so volatile. There's no guidelines yet that say, hey, we can look at your crypto balance and be able to take X amount of that balance and use that as reserves or assets. However, if you do liquidate your crypto, there are ways of recording that and being able to use that crypto money to have as assets, to use as part of your down payment, or to use to cover some of the closing costs.
Okay, I dig it. And I guess determining the difference between assets and income, right? So
Mm-hmm.
with income, it's just money that's coming into your account, right? Assets is just some sort of maybe it can be liquid or it can be illiquid, but it's not the flux of money coming into your account. Is that right?
Correct. So the income is going to be your W-2 job or your 1099 job or whatever you put on your taxes. That's going to be your income.
Okay, sweet. That's all I got for now.
Okay, perfect. Dan, anything you wanted to share?
Now let's keep it going. We're good.
All right, perfect. So, all right, so let's get into some loan scenarios. We're going to look first at the conventional loan for 2021 versus 2022. So, as you can see, we have Johnny over here. Johnny is looking to purchase in 2021, and he also wanted to see where he stands in the market today. So, let's compare. So, in 2021, we had a purchase price of 500K, a down payment of 5%, FICO of 700, 6 months of reserves, an interest rate of 3.5%, and his estimated monthly mortgage is $2,666.50. Looking good, right? All right, so let's
Yeah.
compare now to 2022. So in 2022, our purchase price now is 450K. Everything remains the same. We have a down payment, 5%, FICO 700, reserve 6 months. But this is the big one, interest rates more than doubled. So now we're at 7.5%.
Wow.
Estimated monthly mortgage, yeah. Estimated monthly mortgage, 3,499.33. So as you're getting your jaw off the desk here, we could talk a little bit more in depth about this. And yes, I know that it's a $832 difference, but I know that this is a lot of money to most people, including myself. And as we move forward in the presentation, we'll explain to you why this isn't so detrimental to your wallet as it may seem.
Yeah, I mean, $800, that's like an extra bedroom that you need to have in order to rent out to accommodate for that stuff. But I know this is a little bit shocking. And to be honest, like I'm seeing that too, especially when I punch in numbers like, what is a good investment, right? But I'm sort of like teasing what sort of solutions we have as realtors and as a lender to like, hey, this can be all fixed in the long term. So that being said, it's it is a considerable change, but not all is lost here.
Yeah, you're going to get a lot of analysis paralysis if you just focus on how much more you're paying a month in your mortgage. So, hey, as long as the numbers still work, then it's a deal, right? I do want to say
Yeah,
too that go ahead, sorry.
no, I was just gonna say, yeah. I mean, for most of us, we're in this for the long haul too. So if you're looking at a 1 year projection, then yeah, obviously it's gonna look scary and terrifying. But if you're looking in this long term, like 10 years from now, I think we're gonna be good, especially when we get into the details that you're about to get into.
I agree. And these estimated monthly mortgages include your principal, interest, taxes, insurance, as well as your mortgage insurance. So I estimated your taxes and insurance. So, of course, these numbers will fluctuate. This isn't a set in stone number. These are just estimated numbers. So, as we move forward, all of that calculations are included in your estimated monthly mortgage.
Nice.
And the reserve, Sterling, is that just that's money you have to have in the bank, correct?
That is correct. And the reserves will cover your principal, interest, taxes, insurance, and mortgage insurance. So if you needed 2 months of reserves, it would be your PITI times two. That is what you would need for reserves.
Yep, perfect.
All right. So now let's look at FHA loans last year versus today's market. So purchase price last year, 500K. Everything remains the same. FICO 700, reserve 6 months. Interest rate 3.375, a little bit lower. Estimated monthly mortgage $2,779.05. In today's market, we're looking at a purchase price about 450K, down payment of about 5%, FICO 700, reserve 6 months, interest rate 7.375, and your estimated monthly mortgage of $3,612.42. Now you may be asking yourself, well, hey, that's a lower rate than the conventional side. Why is my monthly mortgage more? And that's because of FHA's mortgage insurance. So any loan with less than 10% down, the FHA has a guideline that says you must pay a premium of 0.85 on that loan. And if you put 11% or more down, then you must pay 0.8% in mortgage insurance for that loan. So as you can see, that drastically, well, not drastically, but is a little bit more than your conventional side.
Yeah. I will say too that for those that are not seeing this, that are just listening to the podcast, the two main differences here is, I mean, you still got the same down payment, that 5% down payment in both scenarios of 2021 versus 2022. The only two that have changed in the 2021 versus 2022 scenarios is the purchase price, which in 2021 is 500K, and the interest rate, which is 3.375 in 2021. So in this day and age, we're seeing possibly that same property go for 450K, which is 50K less than the 2021 version of it. And the interest rate is significantly higher as well, 7.375 versus 3.375. So that difference, just to summarize it succinctly, we got a monthly mortgage in 2021 of about $2,800. In 2022, we're looking at about $3,600. Still that same $800 per month difference in the FHA situation versus the conventional. So not too much of a difference.
That is correct. All right, so let's look at a variable in today's market and how that can help you. One of those variables being your FICO score. So this is one of the major components to your loan and what lenders are looking at. So in 2022, the purchase price is $450,000, down payment 5%, everything remains the same besides your FICO. So your FICO has increased 60 points. So now we're looking at a 760 FICO. Reserve stays the same at 6 months. Interest rate, look what that does to your interest rate. Now we're at 7.25% on conventional. Estimated monthly mortgage, $3,316.05. So Johnny was able to raise his score 60 points, and look how that affected his purchasing power. So you got about a 0.25% rate break on there. So let's look at the FHA side of things.
Nice work, Johnny.
Yeah, good job, Johnny. That's great. Purchase price, $450,000, down payment, 5%. FICO, again, he increased 60 points, so we're looking at a 760 FICO. Reserves stay the same at 6 months. Interest rate now at 6.75%. So he received a 5/8 difference in percent decrease in rate. Estimated monthly mortgage, $3,429.39. So again, you could see kind of the difference comparing these two and how your mortgage insurance will increase your payment on the FHA side of things.
Mm-hmm. Why in the world would someone want to do an FHA loan versus a conventional if they're going to be paying about $100 more per month? That doesn't make sense to the untrained eye.
Yes. So on the FHA is a government-backed loan, which means in the case of a borrower defaulting on their loan, the government backs that loan and will pay that loan. So there's some cost involved with that. There's a 1.75% upfront mortgage insurance premium fee that you must pay. And then you're also paying that 0.85% in mortgage insurance, and you're paying that into the bucket. So that's basically your cost of doing that loan is you're putting money into that government bucket so that this program can be available to all borrowers. Now, FHA loans are geared more towards underprivileged, less fortunate borrowers, some that may have some credit history that they need taken care of, or a low FICO score, or not as much reserves, or things of the likes. The FHA loan program is geared towards helping those clients become homeowners.
For sure. And just to be 100% sure, FICO is the same as credit score, right? Bringing up 700. Your FICO at 700 to 760 is the same as saying your credit score up from 700 to 760, yeah?
That is correct, yes. All right, here's where things get interesting. So I know you might be thinking, hey, Sterling, there's no way I can get my score up 60 points. It's just impossible. Well, don't worry, there's still a way to save money in today's market, and let me show you how. So 2021 conventional, list price $450K. Your contract price, however, was $500K, so 50 over asking. Down payment 5%. FICO 700. Johnny's FICO remained the same. Reserves 6 months. Interest rate 3.5%. Estimated monthly mortgage $2,666.50, as we mentioned before.
Yep.
Now let's take a look at today's market. So 2022. List price, $450,000. Contract price, $450,000. Now, you got in that house at that list price. You didn't go over asking. Everything's looking good. Down payment stay the same at 5%. FICO 700, reserve 6 months. Interest rate, of course, more than doubled. Estimated monthly mortgage of $3,499.33. So,
makes sense.
in 2022, Johnny decided to go under contract on this property. He got in at the list price of $450,000. And yes, his payment is more, but remember, you want to date the rate and marry the home. So if you found your perfect home and you just cannot pass up on it, remember, marry the home, date the rate, and I'll show you why. All right, so here's a benefit of buying now. So say you've lived in the home for a year now. That home you bought for $450,000, and you've reached out to your lender, or your lender has reached out to you and said, hey, Johnny, we've seen interest rates decrease. Let's take a look and see how that can help. So now your new loan amount after a year, after it's been amortized, is about $423,000. The new interest rate that's being offered is 5%. So your new monthly mortgage at that 5% is now $2,672.59, which has an effective savings of about $40,006.04. So instead of paying your $50,000 over asking, you paid roughly $10,000 extra in interest over that course of the year. But you didn't go 50K over, so you're effectively saving $40,000. Great way to keep growing your money tree and using that extra cash that you would have spent last year in the market to go put a down payment on another home or go invest in another appreciating asset.
Yeah. feel like this is the most powerful slide in my opinion. I mean, this is
For sure.
back in the day, people were frenzying over properties just because super high demand, really low supply, obviously, but interest rates were like 2.5, 3.5%. It was insane, right? But here you are showing us that like even an interest rate drop from 7.5 to 5%, which is much more likely than going back down to like 3.5 or even 3%, that is still getting you the monthly mortgage as if you were to get that, that 50K that you would have lost back in 2021, So you're saving so much money in that monthly cost that you're not showing as an upfront cost as of last year. So I find that to be super important and got to be highlighted, underlined, italicized, and bolded, if you ask me.
Yeah, I mean, $40,000 is a lot. $10,000 is a lot too. But, instead of taking out that 50K and putting it into that home, and now prices are correcting and your home isn't worth that much anymore, you'll be glad that you didn't go in and put in over asking amounts and you only paid 10 grand in interest. And hey, if rates come down just 1%, then you should still look at that refinance because hey, your interest payment is going down even at a 1% decrease. So always good to keep watching the market, stay in touch with your lender, make sure that you're doing what's best for you and you're working with a great team that's offering you the best savings at all times.
Yeah, and the moment you mentioned that too, Sterling, I mean, let's say it does go from 7.5%, which is what we're seeing on average right now. I guess confirm that for me before I continue, right? Are we looking at 7.5% ish?
Yeah, so yes, that would be a good ballpark, I would say. I mean, the market is so
Okay.
volatile. The jobs report came out. Jerome Powell had a meeting yesterday, and the market did not like that this morning. So everything is just fluxing so much. It's hard to say for certain what it is, but yeah, sevens are a good number to look at.
Okay. So continuing on that same thought, I mean, going from 7.5% to let's say 6.5 or 6%, which seems a lot more likely even than 5%, right? But let's say 2023, this time next year, looking at November, let's say it does go down to 6%. You can refi that and get that better interest rate, which means you get a better mortgage payment, right? But then let's say even early into 2024, let's say like February or something like that, you see it go down to 5.5%. Can you refinance that often? Like, what is there any holdback from you doing that?
Yeah, so your initial refinance period on the conventional side, you have to wait 6 months basically, make six payments. So you'd have to wait that allotted amount of time before you could do anything on the home. So if rates do come down within that 6 months, hopefully they stay there after that 6 months period and you can take advantage of the lower rate. As things progress in the market, yes, you can still refinance. It just has to be a bona fide transaction. And what that means is it has to benefit you, the client, for doing the refinance. You either have to lower your rate, change your term, or do a cash out refi to pay off debts. So, or to invest in something else. So, as long as it's a bona fide transaction, you could refinance. There was a lot of laws put in place after the 2008 crash where people were taking advantage of borrowers and just refinancing them to get them for their money. So lots of rules and regulations put in place where you are not allowed to do that anymore.
Mm-hmm. Got anything, Dan? Feel like I'm hogging
No,
it.
that's great. I mean, you keep answering the exact same questions I'm going to ask, so that's perfect. I guess I was going to add in like just my thought and my overview on this is if you're buying overpriced, like we talked about in the initial scenario, and then now you're buying underpriced, to me it seems like it's balancing out almost. Especially if we're
Hmm.
getting sellers credits, that 10,000 extra you're spending on the higher interest rate is something that we can initially knock off right now just out of the
Yeah.
gate with closing costs being covered. I don't know about you, Ian, but my last few deals have been around that range where, it's almost a balance out. So
Yeah. My buyers, especially going into it, they're cash poor. They don't want to put down as much as they want. they have to put down as little as they want so they can furnish the property so that they can move into the place, obviously for them, but also if they want to operate as a midterm rental or short-term rental, they need to have furniture, they need to have TVs, they need to have decorations. So all of that stuff really adds up, and a lot of people don't take that into consideration with like, what do you actually need? Do you need a lower mortgage payment, which is fine if you want to do the rent by the room situation and maybe have some communal spaces. But if you're doing the, short-term rental or midterm rental situation, you need that capital at the very beginning of your investing career so that you can properly situate it, list it, and have good tenants going forward. So sorry to interrupt, Sterling.
No,
100%.
I was just going to say, to your point earlier, Ian, is, 2-1 buy down, great program. You still have to qualify with today's market rate. However, the 2-1 buy down brings that down 2%. So for the first year, you're paying 2% under market rate on your interest rate. For the second year, it's 1% under that, 1% under market rate that you initially got in. And then on that third year is when the true interest rate hits. So if things change within the first year or within the second year, hey, you've saved a lot of money on upfront. So there's still a lot of great strategies to be had in this market, even though prices and interest rates, are doing their thing. There's always strategies and ways to leverage yourself in order to get the best deal out there.
Yes, Sterling, on top of that, I think we hear a lot about the refinance process. For the people out there that have never been through the process, how much does something like that cost? Like, what's the timeline, and what do people need to prepare or do in order to be ready to refinance in one of these situations?
Yes, great. So make sure that you still have your job, because they will still
I'm
look
out.
at income.
Super important.
Yep, super important that you still have a job, because you're basically going through the loan process again. There are streamlined loan processes, but those are for other loan programs. So we won't get into that today. But make sure you still have your job, and the cost of the loan can be rolled into your balance of the loan. So technically, it looks like a no-cost loan, as those fees are rolled into your loan amount.
Yeah.
Okay.
I
So
mean,
are there fees on top of that though? Like you need to pay like the origination fee again. Do you need to pay a special fee just for the refinance?
So there's no special fees that include with the refinance part of things. Depending on when the last appraisal it came in, you may need to get a new appraisal. So that would be an out-of-pocket expense. But that's basically what all you're looking at as out-of-pocket would be, that new appraisal. Everything else can be rolled into the loan for you. Some lenders do charge origination. So, make sure you shop around and make sure you're getting the best deal for yourself. I was just going to say, at Bank of England, we do not charge an origination. It's just a bank fee. Unless, of course, you have to buy points or something, then, discount points will be added. But there's definitely great programs out there. And for you, borrower, to explore and plug in numbers and talk with people and become versed in this stuff.
yeah. And what's cool about this stuff is that refinancing, I mean, you need to own a home in order for you to have all these options, whether it's a HELOC, refinancing with just rate and terms, or cash out refinances. Like, all of this opens up for you as a homeowner. You can't do this stuff when you're just renting and you don't own a piece of land or a piece of property. So with that being said, like, I myself, like, I went through a cash out refinance situation, and it was over at my San Diego property. I mean, Sterling helped me out with that as well. Well, it wasn't a cash out, but it was just a refinance of like the term and rates and all that good stuff. And I had to go from like the owner occupied loan to the landlord, or just like an investment loan, right? And maybe you can speak a little bit more on it, Sterling, because honestly, I was going through like 2 to 3 other lenders, and they were not able to make it go through. But for some reason, you sprinkle a little bit of that magic in there of Bank of England, and I don't know what you guys did, but you made it all work out, and it's been amazing, man. We're finally cash flowing on the place.
Good. That's awesome. I would say, yeah. So owner occupied versus investment. So owner occupied, you're going to get better rates and things like that, because you're actually living in that property, and that's your primary home. As you get into the investment side of things, well, rates and fees and stuff like that have gone up because they know that you're making money on that property. So those people the investors, the banks, things like that, they're not going to offer the best products to you as they would owner occupied. So now you're in the investment category. So now you have to play by the investment rules. So normally higher fees, higher interest rates, things like that. I'll just bring up another point too. So say you buy now and interest rates are what they are, 7.5, sevens, whatever they may be. And you get in now, and in a year, rates have gone up. Now what? Well, aren't you glad that you locked in today and bought today instead of in a year from now and rates are at 10% or 8%, 9, 12, 15? So, there's some thought process behind that too, is you can't get yesterday's rate. You don't know what tomorrow's rate is going to be. You can only get today's rate.
I feel like it's almost Zen. You got to live in the present, guys.
100%.
If you look behind you, that's just regrets. If you look in front of you, that's just anxiousness. You got to live in the present, guys. Just buy right now. Hold on to it. You won't regret it. Trust me.
Yeah, I will say too, in the history of recessions, which most likely we are going to, even though the government changed the definition of what a recession is, the housing price index has gone up and to the right every recession. So as affordability goes up, then we're going to see what we saw in 2020 with the sellers saying, oh, well, now I know Johnny can afford a $500,000 house. So I'm going to put the house up for $500K because I know my neighbor did the same thing and my friend down the street did the same thing. And I know they can afford it. They're not getting pushed out. So I'm going to push my house price up.
Dude, I can't wait until I become big enough to change definitions of certain words. It's kind of cool, right?
Must be nice.
Nice. Well, dude, Sterling, thank you so much for this. I mean, this is exactly what I wanted to hear. I know we went through a trial run yesterday with all this good stuff, and I was just mind blown by like how much actual effective savings you can get from that stuff. And that's the stuff that I wanted to like bold, highlight, underline, highlight, or italicize, whatever I said, right? But nonetheless, like, this is stuff that people really want to see with how much they're actually saving in the long term. And even with like, I just toured a house today, personally for like my YouTube channel. Go check it out, Ian.realestateagent. Every week I put up a video. But over like on the over on the kitchen island, they had this 3-2-1 buy down. And with rates as they are ish, around 7.5%, the first year it's discounted 3%. The second year it's discounted 2%. And then the third year it's discounted 1%. Now, I don't know, I don't have a crystal ball or anything like that, but I'm anticipating that within the first 2 years, you can refinance into a better rate than what you had when you first purchased the property here in 2022. If you ask me, that 7.5% will soon become 5.5 or 5-ish%, and you can lock that in as a fixed 30-year rate within the next 2 years, if you ask me. So just throwing it out there for you guys that there's a lot of properties out there that are looking for a buyer and need a buyer. So even sellers that are a little bit more motivated to sell, they want to give you the best terms so that they have an easy close. They want things to work out and all that good stuff. So I find that to be pretty interesting.
Yeah, and on those buy downs, the seller has to pay that difference in interest for those 3 years or those 2 years. So with seller concessions coming down, hey, they could even get the price of the house up and use that seller concessions to help you, borrower, in getting into that home. So the only caveat being is that you do have to qualify on today's market rate. However, your payment for the first, year is going to be 3% less, second year 2%, so on and so forth. So yes, I do agree that, fingers crossed, rates do come down within that year, those 2 years, and I hope it's tomorrow, but we can only see so far and do as much as we can. So great programs out there. Yeah, I just wanted to again say thank you, Ian and Dan, for having me on. Here is my contact information. If you want to get a hold of me, my phone number is, wait for everybody to get their pens and papers. My phone number is 951-445-9008. Or you can reach me via email at S as in Sam, Coldani, Coldani, at BOE, Bank of England, mortgage.com. So, Ian and Dan, back to you.
Yeah. I
Awesome.
loved it, man. I feel like it's gold. It's the stuff that we all want to hear, man. And what we needed to hear as well. So, that being said, anything you want to say, Dan, before we turn the tables on him?
Yeah, just real quick, just kind of summarizing that, I think a lot of people are scared right now, and I keep getting a lot of questions and like, is it a good time to buy? Is it this? Is it that? I don't know if there's ever a perfect time to buy, but what I can take away from this is that there's a lot of little things that you can do, like simply raising your credit score, which could drop your interest rate by a 1/4%, as Sterling just said. Small little things, and just talking to lenders, talking to
Mm,
agents that are doing this. Don't count yourself out before you even know the answers yet. Because I've been there. I thought that there's no way this could happen a year and a half ago. And honestly, it just comes down to talking to people.
mm,
And don't be afraid to get told no. Like, worst case is you get a list of things that you need to take care of to make this happen, and then boom, you take care of it.
yeah.
So, Sterling, thanks for shedding some light. I'm sure we're going to get some questions from people, hopefully, and probably have you back on again to, shed some more light.
Yeah.
Yeah,
We'll
would
have you
love
back on
to.
when interest rates are like 4%.
I probably
Oh,
won't
by the way,
have
Sterling,
time
can you
ever.
just make that happen?
Yeah, I'm wiggling my nose, make it work.
Nice. Well, with that being said, I do this with. I said do. I do this with
Doo
every
doo!
guest. I do this with every guest. I turn the tables and give the mic to the guest. So we'll give you about 3 questions. It could go to either or and both of us. Grammar. So let me know what you think, Sterling, and if you got any questions for myself or Dan, fire away. Let's hear them.
Yeah, so are you seeing, when you see the prices of homes start to decrease, how do you get your clients on the other side of the fence? Or, how are you explaining to them that this is still a good time to buy? Other than the stuff that we just talked about, is there any other things that you guys, kind of do or need help doing to kind of explain better to your buyers kind of what's going on in the market?
I could take that one for sure. So yeah, I mean, first thing is talking to your lenders because you guys understand that side way better than I do. So playing out those different scenarios is super important. But also for me, a big thing that I do is we run numbers together. So if I'm working with an investor, especially, then we're actually breaking those numbers down to show the difference between, hey, if we get this at 50K under asking, this is what it's going to look like. And then we use that data that you provide us and we compare that to make sure that, hey, this deal still works. And then also we're comparing to a year from now scenario, which is hypothetical, obviously. But, if the interest rate does drop, which eventually, hopefully it does, then this is what the numbers are going to look like. So trying to back up deals with data and showing exactly what it's going to look like, especially
Yeah.
with our investor clients.
Yeah, for sure. I know with me and Dan, like we work with a lot of buyers, right? Whether that be investors, house hackers, whatever. Even us, like we need to know this stuff for our own investments as well. So a lot of my buyers are house hackers. I want to say like 70, 75% of them have been house hackers. And that's the main thing that gets them through the mortgage payment. So previously, back in 2021, they had a much harder time even closing on these deals because having that risk of over asking purchase prices like 50K over and then having to put in the offer, hey, full appraisal gap, and then wish like wishing on my monkey's paw saying that like, hey, the appraisal has to come in at this number or else we're out. Like that was much more risky than let's say someone coming in at under asking price and then renting out an extra room in order to accommodate for that $800 per month. You know what I mean? So having that upfront cost be not a factor like it was back in 2021 is huge for my buyers right now. So I think that's the biggest thing. And they realize that, the monthly payment doesn't have to be that scary if you're willing to be a little bit more uncomfortable the first 2 years and having that mortgage payment be mitigated by your rent by the room strategy.
Great.
100%.
So, another question, are your buyers saying there's going to be a crash, or are they saying there's going to be a correction? Or have these words that
Mhm.
come up from your buyers?
What do you think, Dan?
Apocalypse, you mean? I think I hear that more often. No, I mean honestly, I don't think anybody knows. I think a lot of things are based on the news and media is just kind of blowing things up right now, but I don't see anything changing, to be honest. People have to buy and sell regardless in any market, any condition. Closings
Yeah.
happen every day. So,
Yeah. I will say too that they're not saying either, and luckily, like we hold ourselves to a higher position. Dan and I, and even the FI team, we hold ourselves to like. I mean, I don't want to put ourselves on a pedestal, but like we sort of have that authority of like, yeah, we are house hackers, we are investors, and we are realtors actively working full time, and they look at us for guidance. You know, I think knowing that they're going to a realtor that is in the trenches and knowing what the offers are like and knowing what the sellers want out of a transaction just makes our life easier as a realtor. So they don't say words like crash or a correction or things like that. I mean, sure, they might see it, but they're like, what do you, they ask more of the questions of like, what do you think about this market? Or what do you, they ask for our opinion first rather than imposing their ideas on us. You know what I mean?
Yeah, no, that's great. And
Yeah.
that opens the dialogue with your buyer, right? So you can have a
Yeah.
nice adult conversation about how the market is going and they're willing to listen. And I don't know if you guys do any stats, but how are rents looking compared to maybe a monthly mortgage or things of the likes? Do you guys do any of that data sourcing and kind of present that data to your buyers? And
Sterling, you know we do that. You know we do that.
hey, I'm setting up the
100%
question.
we do that.
I already know the
Every
answer.
day.
I'm setting up the question
Yeah.
for you guys.
Every day, man.
Here's the softball pitch right here for you, Dan.
I I mean, I'm looking at that. I look at that stuff every single day, like
Yeah.
constantly just looking at different rates. And obviously, depending on your strategy, that's going to change. Are you doing short term, medium term, or long term? You can use the softwares out there like AirDNA. We use that daily just to check on short term rental rates. Um, but in general, as far as, like your traditional long term rental rates go, I'm still seeing things increasing, especially from a year ago. The average rent by the room rate was probably 700 to 750 a year ago in the Denver metro area. Now it's an average of 800.
Yeah.
Would you agree, Ian?
Yeah, I would say even pushing that, like, especially if it's a nicer home or like a little bit more accommodations, let's say off street parking, extra storage space in your garage, all that stuff can be
Private
tacked on
bathroom.
to that rent. Yeah, totally. Like all that stuff, like let's say you have a master, that's like 900, 950 versus your 800, 850 that you're seeing. So sacrifice that little bit of comfortability in order for you to slide to the profitability side of the continuum. So I'm seeing that as well. It's not going to be, I mean, rents increase usually in demand with like inflation, obviously, especially with like the owners or the property owners like wanting to accommodate for like, hey, my bathroom broke in whatever fashion. Like I need to make sure that I'm building up these reserves over time. So how do they do that? By raising rent. So, I mean, I myself have not raised rents, at least as of right now, but like my tenants over in San Diego, like they're loving it right now and they're paying over asking price or over market price right now just because it's a nicer home in a great neighborhood. And some, I know you're pretty familiar with it too, Sterling, like the North Park, Normal Heights area. It's like almost like Rhino or 5 Points, very walkable to a lot of this stuff. So if you have a good property and you take good care of them, they don't mind paying that extra rent as well. So that's another mentality behind it too. Like, yeah, if you raise rent, you might scare off some people, but those that love your property don't mind to pay that extra $50 per month or whatever it might be for your new lease.
Yeah, I was going to add on that as well. There's a lot of people out there that they're throwing some shade, they're hating, and people, that say, the slumlord thing, like, oh, how could you charge $800 to $900 a room? Well, when you're a good person and the people that live in your house actually know who you are, you're not a big management company, for example, like me, and you're providing a safe place where people also become good friends and they
Yeah.
want to communicate because we just went through a pandemic where people didn't socialize for years. Um,
Yeah.
to me, honestly, I do not feel guilty or bad about what I'm doing, especially when you're providing a really, really awesome product. And, going forward, that's something that I'm always going to value.
Know your worth. Dan knows his
Yeah.
worth.
That's
for
right.
sure.
And they would be,
We don't make the rents. I'll tell you that much. The
yeah,
economy does.
they would be paying rent somewhere else. So why not be your house?
Yeah.
Everyone needs a place to
100%.
live.
That's right. Basic
I want to put in one of
necessity.
those
So,
like
yeah.
the fountains where you push like like a drinking fountain and it's got like Kool-Aid coming out. I'm gonna put one of those in my next place.
Mr.
Yeah.
Deeds.
Yeah, that's the one I was thinking of.
Yeah,
There you
yeah,
go. Hawaiian punch. Very
yeah,
nice.
yeah. Hit my foot. Hit my foot.
Yeah.
Yeah. Nice. Well, thank you so much, Sterling, for hanging out with us
Well,
and
thank
for
you guys.
the excellent
Appreciate it.
questions, by the way. I know I was hoping for a little bit more exciting question, like when's your trash takeout day or something like that, or what's the first album you ever purchased? But I'll take real estate any day, to be honest, any day, 24/7. But with that being said, Sterling, how can people reach out to you, man?
Yeah, definitely. So you can find me on Instagram, just started. So there's not going to be a lot of content there yet, but go ahead and give me a follow. It is my first name, Sterling _ lending. Hit that follow button. I'll follow you back. Or you can reach me via cell phone, which my number is 951-445-9008. Or you can email me, and my email is S, as in my first name, Sterling, Coldani, Coldani, and that is at boemortgage.com.
Nice. What about you, Dan? How can people reach out?
Sterling, you're about to get at least 3,000 robocalls for putting that out there. Just throwing it out there. But you can hit me up on Instagram at dan.guenther, REI, or shoot me an email at dan@thefiteam. And yeah.
Nice. I myself am pretty active on Instagram and YouTube, Ian.realestateagents. I post up weekly videos on YouTube, house hack tours, things that you should do, permits, business license, everything you need to get started house hacking, as well as memes and education on the Instagram situation. Come for the memes, stay for the education. If anything, it's edutainment. So love this stuff. And I feel like I had to put that in there. With that being said, so glad and gracious that you guys stuck around for the whole episode. Make sure you leave a like, follow, subscribe, 5-star review, comments, or whatever people are doing these days to make this content beneficial, and share it with people that you think would be most beneficial to this content. And I appreciate your time, guys, and I'll see you guys next week. Cheers.
Let's go.
Thank you, everybody.